Welcome. Thank you very much for attending this webinar. And obviously brought to you by myself, Adam Harris, and ActivTrades. And the topic for today, at least for the next 60 minutes, is going to be trend trading the city trader way and how to earn an income by trading online. So again, my name is Adam Harris. Now, the first thing I do need to do is to give you an opportunity to read this disclaimer. And while you're reading that, I will tell you a little bit about myself. I'm based in the City of London. I both trade my own capital. I also trade funds for regulated entities in the UK. And I also sort of specialize in providing sort of technical analysis as well as mentoring services for traders who are struggling to achieve consistency. A couple of things that are worthwhile knowing about me as well is that I am a trend trader, which is really just a style of trading. All right, I'm also a swing trader, which means that I predominantly enter into my trades on the daily or 4-hourly timeframes. All right, so although I can trade on the lower timeframes, anything from the 1 minutes all the way up to the weekly or monthly, not a problem. It's just that in terms of it's a lifestyle choice, effectively. It allows me a lot of time to do other things as well as gives me the opportunity to not necessarily have to sit in front of my computer all day long. So on the agenda today, the idea here is to discuss the ways in which we can treat trading as a business. And what that really means is that there must be some sort of structure to the way in which we behave as traders, and we have to effectively behave professionally. So if we treat our trading as a business, it means that we'll be more organized in everything in terms of the way that we structure our time, in the way that we review our performance, and also in ways in which we can grow and improve. So there'll be categories. I want to talk about key strategies. I'll be talking about warning signs, profit targets, as well as risk management. Now, we'll kick off as well. I'd like to spend a bit of time on the platform as well, looking at the current market conditions. And the very first point that I mentioned here under key strategies really is that market conditions matter. And this is something that I don't feel is expressed often enough, right? There's a lot of content out there. It's very easy to suffer from an oversubscription of too much content. That's actually something that can happen where there's just too much noise out there. It's very difficult to find the value and also to find the right kind of information that we need as traders. And actually, in the end, sometimes the best thing is to simply just reduce a lot of that and start to focus on the markets ourselves so that we can start to develop the skills. Think of it as learning to drive a car, and then the difference between having someone else drive a car or us just taking control of the vehicle and actually learning how to drive it ourselves. And sometimes that means that unfortunately we're going to have to cut other individuals out from that, just reduce the clutter. So market conditions matter. We'll talk about that in a little bit more detail in a moment, but this is something that I don't see is espoused enough. There's not enough people who produce or who have platforms, for example, and this could include Bloomberg or CNN or anyone else who's talking about the markets. A lot of them really don't talk about kind of the ideal conditions that we need to take trades in. They'll just be like, okay, I'm trading euro dollar, or I'm trading the indices, the S&P, for example, maybe the FTSE 100. And really what we as traders, once we realize that certain conditions will provide us with many more profitable opportunities, then also it isn't as important which time frame or which market we trade. It really does matter which conditions we get actively involved in. So one of the analogies that I like to use, which is very similar to trading, is surfing. So surfing the ocean, obviously, if we were to surf the ocean, we'd go to a particular spot where we know that waves do occur. On the day, we'd have to assess what are the weather conditions like. Are the weather conditions so flat that there are no waves we can take advantage of, or is it so stormy that it's not going to be safe for us to surf there? So we do need to assess what are the conditions on the day, and obviously then what we're looking to do is to find a set of waves. We know that they tend to occur in sets, and then it becomes about timing. It's very much about timing, making sure we can get on a wave. All of this does take some common sense. There's some safety that's involved because there are risks, and also there's some skill that has to be developed. But there is a point at which we have enough skill that we're actually able to get up on our boards and ride those waves. All right, so and there will be days we might get dumped by a wave, but that'll happen less and less over time. And also the effort it takes to do all of that will become easier and easier as it becomes muscle memory. So this is really what trading is. This is much more akin to how trading is. And a lot of people think that trading is a financial activity. Yes, there are finances involved in it, but actually it's much closer to a sport. It's much closer to a sport where it has a lot more to do with our mindset, our energy levels, our skill, the practice we put in, as well as, whether we rest or whether our heads are clear, are we stressing about other things? It's very similar to that. And actually then the secondary activity is to do with numbers. So this is something we need to take into account. All right. So, and then I talk a bit about key levels and timeframes as well. So I'm going to talk about how market price levels are very significant. Okay, that's how we can organize charts and organize the information that we see on the charts into help find clarity and also to help us identify key levels. And then I'm going to talk a little bit about taking profit, but also about the idea of slowing down. All right, for some reason, it seems to be a popular idea that beginner traders who really haven't developed most of their skills, who might not even be familiar with the platform yet, are trading very low time frames. So they'll be trading a 1 minute or a 5 minutes or 15-minute time frame in the belief that that is what professionals are trading, or that's where they should be trading, or it might also be driven by a sort of excitement as well as maybe greed, just something like that. And that isn't necessarily the case at all. There are plenty of very successful traders who only trade the daily. They simply only trade the daily. It gives them a lot more time to do other things. Trading really is one of those activities where time and money are not necessarily correlated. More time does not mean more money at all. In fact, often the case can be that less time in front of the charts can reduce the analysis paralysis. Okay, there's often when we sit in front of the charts, the markets are constantly moving throughout the day, and we can start to see things, sort of ghosts in the shadows. We can start to see things that confuse our previous analyses. And so this is something that we need to take into account. All right, so slowing down is a very good idea. If I could go back in time and tell myself when I had started learning how to trade almost 10 years ago, you know what, Adam, just trade the daily and the 4-hourly timeframes for the next 6 months, I think my entire sort of history would have been different, because I've also got to get familiar with position sizing, calculating my risk on my trades, getting familiar with the platform, building up analysis skills, and as well as then obviously mastering my strategies. And there's so much to do. And if it's the same again as if I'm learning how to drive a car, and the very first day that I ever get in a car, the very first thing I decide to do is get on a highway during peak traffic. It's absolute insanity. There's way too much happening, and it's dangerous in its own way. So the best time would be to have things slow down, have the markets move a lot slower, allow me the time to process the information I'm seeing. And the earnings are effectively the same, whether we trade the daily or we trade the lower timeframes. The earnings potential at the end of the day or at the end of the month, so to speak, are the same. So then, of course, obviously, we need to talk about reviewing trades and improving, and these are very important aspects of being traders. So let's move on and discuss a little bit about market conditions that matter. So there are certain conditions that are just simply too turbulent for traders to make money from, effectively. There's just too much, and it's too volatile. And this is really the problem with this is that volatile markets such as this, and volatility is a relative term in trading. All right, so volatility has two kind of meanings. The first one is volatility simply means movement. We have movement in the markets, and we do want something that's moving. All right, we need a market that's moving, going up or down, so that we can benefit from the changes in price. And then there's bad volatility, which is when they talk about how the markets have become volatile, they often mean that the markets have become too choppy and too violent. Okay, so that would be the weather conditions. Now, if I look at this first kind of image on the left, the problem with this is that there's a sort of relatively equal number of bulls and bears, buyers and sellers in the marketplace here. And therefore, this particular chart has no kind of preset direction. All right, so the one at the bottom here as well is it's kind of lost a lot of volatility. It does look almost similar to a stock, perhaps an equity or a stock, where kind of it's sort of bottoming out at the low end of its price. But actually, if I remember correctly, I think this was Bitcoin. And so there are times when the markets can kind of go to sleep, or there are times when there's not much happening, and neither of those situations are really going to benefit us financially. So what we're looking for, and then we can kind of break our trends into, or at least when the market starts to move, into good conditions and very good conditions. Very good conditions to me would mean that the price has a very clear sense of direction. The trend is strong. There is one side that is very much in control, and that, ironically, although it might not seem like it, it's counterintuitive, good trends are likely to last longer. All right, they're just simply something that's worthwhile mentioning is that professional traders who have paid their dues will trade a lot less. They have a better eye for better opportunities, and they will definitely have a preference for certain types of market conditions, and they simply won't participate in junk conditions. They'll be very much attracted to easier conditions, I'm saying that relatively, and that would be trends. So strong trends will attract professionals, and professionals behave in a much more orderly fashion, and that benefits inexperienced traders as well. There's a lot more order in the way that the market behaves. So really nice, healthy trends just serve everyone better because they tend to just behave more predictably. And so what I would tell myself if I could go back in time is to say, look, focus only on trending markets, trade only in the direction of the trend, and that will offer me the greatest returns that I could have, versus trying counter trend trading or range trading, where actually the problem there is that one side of the market is not in control. Okay. So great trends are really what I want to focus on, and these charts just display examples of where the market is clearly trending in a direction, not necessarily up or down, but just at least trending. So key strategies, when we talk about key levels and timeframes, very, very important that we pay attention to what the monthly, weekly, and daily charts are telling us, right? The daily chart is still the single most significant time frame for all traders around the world, right? It gives us the best information we need to determine what are the market conditions on the lower time frames, and also the monthly and weekly tell us about key levels that we need to be paying attention to. It's counterintuitive, but it's the higher time frames that give us a sense of direction. They tend to dictate at the end of the day where the market should go. All right. So they then help us, they actually assist us. So we do want to have a sense of what are the monthly market conditions like, or chart conditions, and what are the weekly and what are the daily. Our best conditions arise from when the daily and the weekly, at least, if nothing else, both the daily and the weekly are trending, first of all, trending in the same direction. So any market, any time frame can only exist in one of two states. It's either trending or not trending. And if it's trending up or trending down. And if it's not trending, obviously we don't want to get involved in it at all. So ideally our best, and even if we are trading the 5-minute time frame, statistically we will have more winning trades or a greater chance of success if we are trading in line with the daily trend. Okay, so we want the daily trending, and whatever time frames we trade on the lower time frame, statistically we'll have more winning trades if we trade in the same direction. We effectively have the wind at our backs. So then taking profits, we have to also learn how to take profit. It isn't just that we have to educate, newer traders on putting a stop loss in on every trade so that they can reduce the losses on their existing capital, but also teaching them to take profit, actively take profit, or else their accounts cannot grow. And that's two different trains of thoughts. People need to understand that a stop loss is there to protect and reduce the damage that losing trades, because we will have both winning trades and losing trades, and stop losses exist solely to reduce the damage our losing trades can do to our existing capital. And taking profits is really the only way in which we can actively grow our account. So we need to do both. We need to do one to protect our existing capital, and another to grow our account, to add capital to our account. When I talk about slowing down, I mean swing or day trade. These are two different styles. Swing trading effectively means trading at the daily time frames or higher, and day trading is generally below the 4 hourly. All right, so the money's the same, it's the lifestyle that's different. So when I say the money's the same, the earnings potential is pretty much the same. It's a lifestyle choice that's different. Some individuals want to sit in front of the charts for an hour or two a day at a particular time, take whatever trades are available, and then they're done. They go to sleep at night. They're not exposed in the market at all. and that particular period of day they'll look to see opportunities that are there or not. Whereas certain individuals might want to do the opposite. Swing trading means that for an hour or half an hour a day or even less, they would want to be there to see if there's a setup. What I like about swing trading for me is that there is, because it's at a particular time every day, it's when the markets close, the daily candles, that means there is either a setup there or there isn't. It's a very much a yes or no, red light, green light scenario, and that's it. So it means for me that very small window where I only have to be in front of my computer for half an hour a day to run through the charts that are trending, looking for those opportunities. There will either be a setup or there won't, and that's it. And if there isn't, it might set up the next day, but it isn't happening today, and I can let that go. It also means that during the day, I don't have to obsess over a friend of mine and I used to joke about obsessing about them like they were our babies or our eggs, watching the trades throughout the day. All right, and swing trading, if a newer trader decides to swing trade, but also decides to watch their trades during the day, they become it's very emotionally tumultuous, because swing trading, because the market can change trend throughout the day. So swing trading is something that we should, in order to be more successful at that, we really should actively not look at the charts until the end of the day. So reviewing trades as well and improving, this is something that isn't appreciated enough, but one of the fastest ways, trading journals and mentoring are the fastest ways to achieve consistent success. Trading journals, in a way, is it's a record of the trades we take, but it should always include, and this is very important, technical analytical trading is a visual skill. And this, I apologize for this typo, I just saw this typo now. It's a visual skill, all right? We're trading charts. And therefore, we should always have a snapshot of the trade as we saw it on the chart, as opposed to a written description. We should snapshot the charts. So our journal should always include the space to grab the setup as we saw it, whether we decided to take it or not, whether we decided to trade it live or whether we decided to demo trade it. But we need a record of what we saw on the chart so that we can look at it again. And also we have this beautiful biological benefit. We have a pattern recognition brain, right? Our survival over the last billion years, where we've developed from just mud, effectively, tadpoles in the mud, we have this thing that allows us to build up survival skills by noticing patterns. That's what we notice. That's how we train our pets, our dogs and cats, everything. We teach them patterns. And that's what it is. We look at patterns on the chart, and our brain is always collecting that. It's our unconscious. So trading journals is where we want to collect the trades we took that were winning trades and losing trades, and trades we weren't even sure of. That way our brain can start to build up its own experience of maybe warning signs that it might see that we can't put our finger on, but we build up experience. So trading journals and mentoring are basically ways to fast track our experience. If we try to trade without education, without any education at all, without potentially trading journals or mentoring in that order, we are doomed to make the same mistakes over and over again, because we simply just won't even know what we're doing or not doing. So yes, I was that comment about mud, there's a comment that in terms of evolution, at some point it was just mud, that it was soup. Basically, at some point something just developed in the water on the planet that then subsequently became plants and separated into other organisms. Anyway, it's very funny when we think about it. So, and the other thing, and this is completely random, but most people don't know this, random piece of trivia for you, is that whales came from land, and most people don't understand this, but they also have leg bones that are still remaining in their bodies, and most people understand that's why they're mammals, because they came from land. So basically we went onto land, and then some animals went back into the water. So trading journals and mentoring are the fastest ways to achieve this consistent success, because we can learn about mistakes, realize if we're applying our strategies correctly or not, identify mistakes we're making, but also if we're doing the things correctly, we will, it's a bit of carrot and stick approach, but it's our own carrots and stick in a way. And mentoring, every trader generally has made the same mistakes, right? And they've overcome them. So it's good to know when you talk to another trader that you're on the right track, almost more than anything else. So there we go. So these are important aspects to help leapfrog us. But also there are times when if we find that, often if we have a losing trade, we don't know if it's something we did wrong or if it's something that the market did wrong. We do understand right at the outset that we're not going to have all winning trades. We get that. But we just don't know how to differentiate between a mistake that was something we could have avoided, that's on us, or something that the market did. And that the trading journal will help with that. Mentoring helps with that, and education should help with that as well. So education is very much an important factor in that. And it isn't about having 10 different strategies at all. It is very much about building up our technical analysis skills, being able to look at the charts and go, this chart is too volatile to trade, or this chart is looking really nice and bullish, this chart's looking really nice and bearish. So that's why I want to make sure I can get to the platform and show you some of these items here. So I talk about warning signs now when it's the trader. So basically, there are times when there are warning signs that stuff isn't going right, and often it's the trader that's the problem. So I just want to answer these questions as they come up here. So the question here being, what kind of journal do you keep, paper or electronic, or do I use an app? Now, there is an online application that's quite popular, but for me, my personal preference, and it is, I think I'm the only person I've encountered, some people like PowerPoint, so they can write notes and they can screen grab the charts and they'll put it in a PowerPoint presentation and store it. For me, it's Excel. All right, I'm very happy to keep an Excel spreadsheet. I can copy and paste charts into an Excel spreadsheet, and I can store the dates, the entry, the time frame, where I got in, where I got out. It should be something, ladies and gentlemen, that only requires somewhere between 1 and 3 minutes to complete. That's it. If it is too time intensive, it is going to be unsustainable. In the same way that if we wanted to stick to a diet or eat healthy, if it takes us 5 hours to prepare a meal that takes us 10 minutes to eat, it's unsustainable. We need to be able to prepare meals and eat them very quickly. It's the same way with trading. The journal should be really only a minute or two of our time. We should see the benefit of it within a few days, even by just tracking down the trades that we saw, snapshot the time frames that we saw them on, the charts we saw them on, and also perhaps maybe making comments of things we liked about the trades and things that concerned us. But that's very, very important. And again, that's much easier to do if we're looking at daily charts. Okay, so let's just carry on with these warning signs for the moment. When it's a trader, if the trader's jumping between strategies, right, that's not a good sign. If they're trading too low a time frame, again, it should have been time frame, not time frames. I'm usually better at this in terms of typos. Anyway, and trading only one or two markets where the trader has been instructed by somebody they met that they should only trade the euro dollar, for example, on the 5 minutes, maybe using a MACD crossover, right? And that'll be a strategy that historically hasn't necessarily worked, and they're only focusing on one market, not really taking the conditions into account. Should I even be in the market today? Is it too volatile? Or what am I looking for? And often they focus a lot on the strategy and not enough on the technical analysis. Then they trade without stop losses. They're subscribing to too much content, which is the problem with the entire world today, meaning just the internet has more than enough content for any topic in the world, not just trading, but for anything. And so there's always a difficulty with that. What we should be doing is trading should be logical, and I'm going to say this again, it should be logical, it should be rational. It is an evidence-based activity. We build up a case to get into a trend, for example. So if I'm a trend trader, first of all, I need to know, what does a trend look like? So I need to know visually what that looks like. When I can recognize it, then it becomes a question of, okay, I found a trend. Now I just need to find a trading opportunity, and a trading opportunity is an entry into that trend with a guideline as to where to put my stop loss in case statistically or randomly the market goes against me, and where to take profit so that statistically or not so randomly it goes in my favor. And so therefore, subscribing to too much content, for me, the content should be demonstrating good technical analysis and demonstrating where to get in and where to get out, showing why, what's the reasoning, what is the rationale behind taking the trade. And also warning signs, ignoring price action. Okay, so price action is the basis for decent trading. It's a learnable skill, ladies and gentlemen. So when it's the market, all right, so when the candlesticks change size, all right, let's say on the daily time frame, we see that we go from small candlesticks. We'll have a look later on, looking at, say, the S&P, for example, the global indices. When they start to go from very small candles to really big candles, that's just an increase in volatility. That's telling us that if we had losing trades during those periods, it wasn't necessarily us. Divergence, a key level. So divergence, for those who aren't familiar with it, divergence is when there is a discrepancy between the indicators, the MACD, the RSI, stochastics. There's a discrepancy between them and what price action is doing. So price will be creating fresh highs, but the moving averages of the indicators will be going lower. That would be called divergence. That would be a discrepancy between the two, and it's an indication that the trend is becoming exhausted. Other things, for example, would be high impact news. That could be non-farm payroll out of the US, any US markets, high impact news, FOMC, interest rate changes, elections, right? All of these things can create really big impacts across the markets. US markets can impact all currency pairs, for example. And we're not just talking about currencies, we're talking about commodities, we're talking about indices, shares, as well as currencies, but the US news, when it's really high impact, can have a knock-on effect. And bad ideas, okay, it's generally shown to be a bad idea to trade the news. All right, trading the news, even if we knew what the figures, the numbers were going to be from the news, we cannot predict how the market is going to react to it. So generally speaking, trend traders are wanting to trade a trend that they hope will not be disrupted by any news. So for them, news, we want to keep a track, we want to use an economic news calendar, identify when medium or high impact news is scheduled to be released that could impact the trend we're on. Okay, so if we're trading during the day on the lower time frames, we will potentially not get into a trade in the 2-3 hours running up to that big news. If we're trading end of day, it's less of a factor. And also bias by media. It's very, this is something that just nails beginner traders for the first couple of years. They're constantly listening to Bloomberg or reading the news, or listening to the doom and gloom and the sky's going to fall kind of content that is everywhere. All right, and they allow that to influence their thinking on trade. So they start shorting the stock market when it's very bullish, and they start buying the euro or selling the euro because they think that Brexit is going to have a negative impact or whatever. They get an idea in their head that isn't based on what the chart is actually doing. And so often, if the market is going up, they're selling it. All right, and that's the kind of stuff that just destroys traders and their accounts. So that is a very bad idea. Okay, so bad ideas to do that. Now, good ideas are keeping it simple, focusing on price action, horizontal levels, taking note of what the higher time frames are doing, using stop losses and taking profits. Those are way better things that if we're going to keep it simple, that's what we should be doing. Also applying probabilities and common sense. Okay, another analogy would be throwing a basketball through a hoop in the backyard, for example, in the driveway. If we're not good at throwing, the one thing we should know from experience is practice makes perfect. By practicing over and over again, maybe by standing closer to the hoop, eventually over time, we could probably even do it blindfolded. We get so good at doing it, we could stand very far away and still throw the ball through the hoop. Although we do understand that on occasion, we're not going to make it. We know the ball is not going to go through. But there's a point that comes from practice over and over again that we develop a confidence in and a faith in ourselves and muscle memory. We start to realize that this is, you know, I'm on form today. I'm definitely able to throw the ball through the hoop. And it's the same with trading. Through practicing, watching price action and doing the same things over and over again, it does become muscle memory and it becomes a lot easier. And once we've taken enough trades where we've mastered a strategy, where we now have a sense of what price action is doing and we're paying attention to the right things, we start to know, we get a sense of knowing that the trade is a very high probability winner. We don't take it personally when it isn't a winner, but we tend to suddenly start to have more winning trades than not. So not every trade can be a winner, naturally, but I also think, and this is the approach we took at one of my companies, that it's very reasonable and realistic to find 2 to 5 trades per week. These are high probability setups where there is potential profit on the table for the move. We can see the price action setting up, we know where to get in, we know where to put our stop loss, and we know where to take profit. So 2 to 5 trades per week. Ideally from that, and this is a conservative approach, yielding a net profit of 1%. Okay, a net profit of 1% should be feasible. Through compounding, that would be close to 5% per month. So And it's worthwhile mentioning on that note, you know, if I was hoping or aiming or trying to do 7% in a month, I wouldn't aim for 7%, I would aim for 5%, and the compounding would raise it to 7. So we need to be aware of that kind of thing. Now, I've also said here, take profits at 1-to-1 and often. So one of the things that I've learned over the years, and most of the very amazing traders I know, is taking part profits at 1-to-1. So this refers to when we've achieved our first target on a trade. It usually is referred to as a reward to risk, or an R1. For example, we would look to take some profit off the table. Now, I think most of my colleagues do as well, we take about half the profit of our open position off the table at 1-to-1. And we do this actually on every single trade, And what this does is 1-to-1 is relatively easy to achieve. It's 2-to-1s and 3-to-1s and more that are very difficult, where the market doesn't move as far as we think it might. And so 1-to-1 allows us to achieve a large number of basic winning trades and create bread and butter. 2-to-1, we then consider 2-to-1s and 3-to-1s as cream on top. And also 1-to-1s, because they occur so frequently, we can often get our trades to break even, which means we have fewer losing trades. We might have break even trades where we don't make any money, but we didn't lose any money. So profit targets, we want to talk about being realistic and sensible. So what does this mean? It means that on the whole, when we're looking at trending markets, we think it's reasonable if we have a relatively tight, small distance between our entry and our stop loss, that we should be able to achieve, on average, a 3-to-1 reward to risk, meaning that on average, the market move before we're out of the trade entirely would be about 3-to-1 on average. Now, for example, with me with currencies, because currencies can trend for very long periods of time, but also they can range a lot, I tend to focus more on a 1.5 or 2-to-1 than I do a 3-to-1. And if it continues trending, that's fine, but I'm prepared for shorter moves. So also I need to know where key levels are. The key levels are horizontal levels, price levels that I'm going to look at on the charts that tell me kind of where I can get in and get out of the markets, where price is likely to potentially change direction. And so usually I would use those levels as a guide as to how much potential profit is left before price, before price gets there, how much potential profits on the table. Previous highs, so if I'm in an uptrend, we have swing lows and swing highs. If we look at price, we will get a sense of how much potential profit is there when price comes up to the next high in an uptrend, for example, or a previous low in a downtrend. I'll talk you through that in a moment. And also taking partial profits, which I spoke about before. So we need to be aware of things like full win. A full win would be a 3-to-1 on a strategy we have. So strategy should have a general expectation of a 3-to-1 reward to risk, for example. Maybe partial wins would mean I only got 1.5-to-1 on some of those trades, or break evens, meaning I took profit off the table, but then the market came back and stopped me out. So it was a no lose trade. It was a no win trade as well. And then full losses. So this is a better way to look at for example, every 10 trades we take, it's much better to look at this to get a sense of how the numbers work in our favor and how we can do that. Okay, so just also having a look at your comments. Okay, so there's a question here saying it's a very small window, which is why it's difficult for me to see them. What about Brexit? Big news events. Do you avoid not missing an opportunity? So for me personally, I stay out of the market when we have big events like that. And there's a couple of practical reasons for that. Liquidity is low. All right, the very, very big money will often have positioned itself before time, or will have removed itself from the market so as not to be caught offside. I mean, that's big money, and they would step away from that. So liquidity can often drop in those situations, which means there's slippage, there's gapping, there's all kinds of funny things, and it becomes basically like it just becomes bloodshed. And so usually in those really big events, I would completely avoid it. And most of the time I find people stress a lot during those situations, and not avoiding it just for one day, for not trading for one day, can often just mean, okay, great, because the market can just swing around and swing wildly. So it's just taking a day off. You can watch it, but I'm just very cautious about doing that. Okay, let's move on. So yeah, risk management, keeping risk small, 1% or less per trade. If I have a bumper month, let's say I'm looking at a lot of 3-to-1 trades and I have a bump a month where maybe I take 15 trades, and let's say that 10 of those are 3-to-1s, and I have maybe 2 losses and 2 break-evens and another one that's a 2-to-1. I mean, with the compounding and stuff, that can often achieve a 10+% greater per month. Now, for small accounts, it's much easier for us to do that because we're not impacting the market at all. Our accounts are usually so small. Warren Buffett isn't capable of putting that kind of capital into a single position because he'll move the market, and if anyone catches on that he's doing that, you know, the rest of the market will kind of adjust accordingly. Whereas with most of us who are dealing with normal sized healthy accounts, we can do that without it impacting us. But we shouldn't underestimate why keeping risk small is that when it doesn't go in our favor, it's a small cut. Whereas if it does go in our favor, we can build up from that relatively quickly. I do like to diversify there are opportunities that aren't just in currencies. There's incredible trends that can often sit in commodities or indices while FX is doing nothing. And I've seen traders who for some reason get in their head they should only be trading Forex. And they have a terrible year that they're just about to quit. And in the meantime, the other markets have been trending beautifully. So, and then of course they'll be under the opinion you can't make money trading, or they're doing something wrong, or their self-esteem has taken it, when in actual fact, again, it was the wrong market conditions. That's an example, but that's based off real stories as well, real life experiences. So stop losses, trailing stops, and taking profit, very, very important. So, and also here, controlling our exposure to the media and the charts. So for me, although I read the news, I generally don't love it because well, it's improved recently. I was saying I'm seeing better journalism these days, but I would say for the last 10, 15 years, there was this swing towards low quality journalism. In order to save costs, they were outsourcing it, and also just people writing more. You know, the Kardashians didn't come out of nowhere. This is something that was obviously encouraged, and so drama was a big factor in reporting the news. And so reading the news, I would create a massive amounts of emotion and bias, and that's what it was designed to do. And this really wasn't good for us. It's junk food, effectively. Whereas today, I'm seeing the quality improve slowly, but just monitoring the exposure in the same way that we would control how much junk food we can eat, controlling that exposure to the media and being selective about which media sources we trust, will have a lot of benefits to us. And also not spending too much time in front of the charts where we start to see things that aren't really there. Sharpening the saw is a famous expression. It really just means understand that we can continually improve. As I said, there's a point where I can start to, if I'm surfing, I can get up on the board, I can ride the wave, so I'm actually doing what I need to do. But there'll be a time when it'll become unconscious and become incredibly easy to do, and I won't even be thinking about it. I'll be caught up in the moment of riding the wave. And it's the same if I'm throwing that basketball through the hoop. At first, it requires effort and practice and concentration, and after a while, it'll just be so easy to do. So it does become, relatively speaking, easier to do, but it takes practice and time. And trading is very much the same way. There's a point at which I started to make more money than I was losing, which is that tipping point. But from that point onwards, there's plenty of room to improve. Suddenly I can take 5 trades instead of 15 and make the same kind of money. And I enjoy it more. So sharpening the saw is just accepting that there isn't a point at which you arrive and go, okay, I'm a trader now. You are a trader the second you start learning how to trade and start applying it. But there's a point you need to understand that you can always improve. It means less pain or more fun or enjoying it more, or learning more, knowing more. And sharpening the saw is just understanding that the journey is an ongoing one. So I'm just keeping an eye on the time. We've got about 15 minutes left. I might run 5 minutes over because I started a few minutes late, just to make it a round one. We'll see where we are at the top of the hour. So I'm just going to talk you through an example of a Forex strategy that I like to use. Now, the reason it's a Forex only one is actually to do with the band. So I'm using envelopes, and the envelopes fit around all currency pairs, but they don't necessarily fit with the same settings around other instruments. So I focus usually on that. And what I've got here I'll show you on the actual platform in a moment, is I've got a daily chart and a weekly chart. So daily chart on the top and a weekly chart at the bottom. The reason I have both here is so that I can confirm that the weekly is going in the same direction as the daily. So I'm also using a 20 and a 10 moving average. So it can be an 8 and 21. That's also a well-known thing. 10 and 20, it's not crucial. It's more, let's just say with 10 and 20, it just gives me a shorter term. It just gives me an order in which price will often interact with those moving averages. And I can see if I look at price as well. So these turning points at the top are called swing highs. Turning points at the bottom we call swing lows. So I can see here I've got a swing low that goes to a swing high and down to a swing low and another high. So this is now in an uptrend. So I'm not just obsessing about price's relationship with the moving averages. I'm not worried about the moving averages crossing over. I'm noticing that price on the weekly is now trending up. So what does that mean? It means the weekly is now in an uptrend. I can see actually in principle that the daily is also trending up. And so what I've also got on the chart is the MACD and RSI. I use these actually, and I very rarely use them, but I use them just to identify if the trend is becoming exhausted. So they're not a very big part of everything I do. In fact, if I do this right, I very rarely have to check them at all. One of the ways to think about it is if I'm driving in my car, if I look through the windscreen, everything I see on the charts, the bars, horizontal bars, or the OHLC bars, horizontal levels, moving averages, that's what I see through the windscreen of my car. That's other traffic, roundabouts, pedestrians, cyclists, so on. That's crucial. If I look down at the dashboard of my car, I've got a pedometer, maybe a petrol gauge, and these are items that assist me, but there's no way I could drive successfully if I blocked out my windows and I wasn't able to see through them and I was looking at my petrol gauge and speedometer. Wouldn't be able to drive very successfully, but I would be able to still drive and function normally if I didn't look down at my dashboard, but I paid attention to it. So the most important information is what's in the charts. So I use a daily and a weekly chart. I've put on a 5 moving average and a 10 and 20 and 50 as well. That's absolutely fine. And they can be set to exponential, which is just a calculation on them. So I've actually got them snapshotted here. So it's a 5 period, for example, exponential close. I've also put on a default MACD and RSI. So default settings, nothing fancy about that. And I've added 2 envelopes to the daily chart. Okay, so I've added as an indicator 2 envelopes to the daily chart. These are the 2 settings. So basically the only difference between them is they're both 5 period, they're both set to exponential and to close. But one of them has a deviation of 1.2% and the other has a deviation of 0.6%. So this is recording. If you got the recording, you can pause it here and have a look at that. Now, so that's it. I have one with a 5 period deviation 1.2% and another with a 5 period deviation 0.6%. So that's what it is. And so that will result with the envelopes being placed around the price action. So I'm going to talk you through this in a moment. Just want to run through the idea in principle. In order for me to go long, I want price just to be above that 50 moving average on both the daily and the weekly chart. So the reason for this is to assist a newer trader in just making sure that price is heading up and not down. So if both the daily and the weekly price is actually above the 50, that should mean that both charts are trending up loosely. If the trader is familiar with higher lows and higher highs or an uptrend, they would use that as well. Price should have at least 2 retracement days to seller bars. So let's go to the platform and have a look at this. So what I'll do here is go through to this and have a look at these items here. And so what I'm going to do is just drag this into a couple of these charts here. So this is a great example that on the bottom chart, I've actually got that uptrend, high lows, high highs. Price is now at least above the 10 and 20 moving averages as well. And on the daily, I can see prices above the 10 and 20 moving averages, and I can see prices now starting to come down. So usually what I'm looking for is I'm looking for at least what I want, and this is the plan here, is I can see that price pulls back into the moving averages. So this is the concept overall, ladies and gentlemen. Price will head away and pull back into the moving averages, and then head away and pull back and then head away. And so what I'm looking for is to have price pulling back. And so when I talk about having a minimum of 2 retracement bars, I want price pulling back towards these moving averages. Okay, and so that what my plan here is to take advantage of the next move to the upside. So I've got an uptrend here on the weekly, which means that in principle that should be heading up. And both, obviously the weekly and both the daily, will do this breathing out, breathing in, breathing out, breathing in. I'm looking to trail an entry behind each daily bar until the market turns around and resumes, does the next move to the upside. So this is known as an extension in the direction of the trend. and a retracement. I'm looking for it to do the next extension. And the way that I do that is making sure that the market is pulled back towards the moving averages. And what that means is if you look at this envelope here, I've got 4 bands. So the envelope is really there just to give me a sense of relative, where is the market relative to this? And usually I want it to pull back somewhere into the last 3 bands. But the point is, the idea is simply that I'm looking for price to pull back. I'm then going to trail an entry behind the daily candle until price turns around. And so, for example, today's candle is still open. So my entry would potentially be sitting behind yesterday's high. If today's candle, when that closes, I will put an entry above the high of that. And then tomorrow we will see if I get triggered in. So it works quite nicely because there's often a very nice pullback into that. So let's just have a look at dollar CAD. Let's see how that's going. So for example, dollar CAD now has started to move slightly lower. It's a bit of a downtrend. What I'd be looking for is to have price pulling back towards the moving averages before heading away and pulling back. Now, unfortunately, in these situations, I really would have been nice to have 2 little green bars pulling back, and I would start to trail my entry behind it. As the trader becomes more experienced, we can start to see this. But the instructions are really just to help beginner traders get a sense of this. So let's go back to the slide deck here. So in order to go long, I want obviously price above the moving averages on both the daily and the weekly charts. I would like to have price ideally to have at least 2 retracement days, meaning that the candle, the bars, the OHLC, or the 2 candles are coming back down towards the moving averages. And that is an earlier point, because sometimes the market will do a single retracement day, and it's generally, in my experience, not enough. I want to make sure that I've had at least 2 retracement bars as price pulls back. Once I get the second one, the second bar, and any subsequent bars, because it could continue, it could produce 3 or 4, I would trail an entry above that bar as it retraces. And usually my stop loss would be below the bar. So in this case, if I go here and go, let's go long again. So let me just throw on cable. So let's throw cable on here. Cable's actually on my watch list here. You can see it's now in an uptrend. So GBP USD, sterling is up. I could see it's retraced here and taken off, and it's currently retracing. So there we go. I've now got my first retracement coming back to the moving averages. My second one is currently opening, which means tonight, when this bar closes, I'm going to be potentially placing an order around this. Usually I would trail my entry above the high, just above the high, usually taking the spread into account, and my stop loss below the low of that bar. And so tonight, depending on where this closes, I will put my entry above the high of that and my stop loss below the low. And definitely in terms of position sizing, I'm going to make sure that that's 1% of my account. That's actually a separate webinar worthwhile having, but I want to make sure that I don't risk more than 1% on that particular trade. Let me have a look at your comments as we go, and I'm just keeping an eye on the time. We've got about 6 minutes left, and I just want to see how we're doing there. Okay. So, and I'll go to the charts and have a look here. So this was interesting. I actually highlighted here where some of these opportunities were. There were a couple here. There was a couple of retracements here. There was actually 1, 2, 3, 4 retracement bars, and then it took off. There was actually another pullback, took off again, another pullback, and it took off again. And so we've had a couple of pullbacks here. And even in situations here, for example, where this was a losing trade or potentially a break-even trade, there was a little indecision bar, put my entry above that with my stop loss below the low, got taken into some profit for sure, but subsequently came back and would have hit whatever stop loss I had in place. But pulling back also provided a potential entry above the high of that. And at any rate, so there's a couple of trades here, for example, here, that one was potentially a losing trade, but this would have made some really good profit, and we've currently got these setups unfolding. All right, so that's pound Kiwi. So that'll also be on my watch list. So just interesting, this one would have potentially been a, that would not have made profit there, but if I'd stayed open on those trades, I would have made profit here. That would have been profitable. That would have been a losing trade, and that would have been profitable. So there's a mixture of winning and losing trades. But the goal is that I'm trading in the trend on the daily and also in line with the weekly. That is also producing high lows and high highs. So this is very important. I don't want to be trading an uptrend on the daily where the weekly is potentially underneath these moving averages. To go shorter would be the same idea. I'd have price underneath the moving averages on both timeframes. You can see here it's producing lower high and lower low on the weekly. and the daily is now underneath the moving averages. You can see there's areas where prices pull back into the top sort of 3 bands of the envelope. It's just retracing before it takes off, retraces again, takes off. This was a very interesting one. It retraced here, went sideways. So I've put arrows where there was a setup here, triggered, but didn't really carry on, then pull back. There was another retracement here, and then it triggered. There was another short retracement here, and then it triggered. So there have been some moves here that I've taken advantage of. As you get more and more experience with it, you realize, okay, there's going to be a breakthrough at this level. You just gain more experience with it. But the key thing for me was making sure price is not on top of the moving averages. If it's on top, you get a period like this where the market is going largely sideways. So ideally, I want the weekly below the moving averages or above the moving averages, but not on the moving averages. That's when the market is going largely sideways. So the way in which I can then scan for trades will be when I can drag and drop a currency pair on. So put CAD Swissy there. Let's have a look at that. Put CAD Swissy here. Here you can see this is the problem. It's sort of crisscrossing on the weekly over and over and over again. And the end result of that is that there's not enough of a trend on any one side of the line. If I go and switch it to, say, pound yen, here you can see it's been largely underneath the moving averages, and now it's shifted back over. And that will happen. There will be times when the trend will change. If I look at this and if I just sort of zoom out a bit, there was some amazing, during this period over here, there was some incredible downtrending moves there. And now that it's shifted across, there are now more opportunities to the upside. So I'm buying a lot of these opportunities here. And that gives me a sense of direction. And I don't need to know what's happening with Brexit. It's moving. I mean, this is going back even here to June. It's a slow process. But my returns on multiple, I mean, at any one time, I could have 7 or 8 trades open in a week. And these trades might stay open for anywhere from 3 days to 8 days. And I'll have multiple ones overlapping with each other. And the returns are very nice on these, but it's no more than 1% per trade. So best results from the strategy are achieved when the trend is smooth. Smooth, meaning I can see it's just flowing very, very nicely. It's not choppy, it's not too volatile. When the daily candle is small, and my entry and stop loss are on either side of it, that means that it's quicker for me to get to 1 or 2 or 3% or 3 to 1 reward to risk. And obviously I want to check the price action for trend. So that example, that means that I look at the weekly. I'm not just looking at the price's relationship to the moving averages. I'm looking at the higher lows, the lows and the highs. Is price trending? Do I have lower highs and lower lows in a downtrend, or higher lows and higher highs in an uptrend? So that is always something that we need to learn to do. It isn't just about price and the moving averages. What is price itself doing? Risk always 1% or less, and stop loss can be trailed at the end of each day. So again, when I sit down tonight, I'll look, are there any new setups? Do I need to update the stop loss from already open trades? Do I need to cancel any orders that haven't triggered or update those orders? So, and that becomes a routine, which is the business side of it as well. Okay, and again, there's not too much emotion in it. If I do this habitually, the profits will come actually. So let's just go back and have a look. I believe we're now on the final slide. What I'd like to do is open this to the floor. If you do have any questions, then please feel free to ask away. If you are interested in seeing more examples of this, as I've said, you're free to follow me on LinkedIn. I prefer LinkedIn. There's very short videos where I talk about the stuff I'm doing, just to drive this home, to see which markets I'm following, but also very importantly, which markets not to get involved in. This is something that tends to trap beginner traders because they're so busy trying to understand the platform. MT4 is a fantastic platform for various reasons. It's very robust, very stable, and very easy to learn, even if it seems a bit intimidating. So are there any more questions? Let me just have a look and see if there's any more questions from any of the panelists or anything. What are my thoughts on cable? So let's just jump across to cable and have a look at where it is at the moment. Now, all the GBP pairs are actually looking equally bullish. This is very interesting. If we go look at their weekly charts, what I'm going to do here is make the top on a monthly chart as well. They've all hit very strong levels of support and they're all looking incredibly bullish. There's also a bit of bullish divergence. So it indicates technically that GBP may be looking to head upwards for the coming months, regardless of whatever else is going on. There might be some, we might have a really big move around Brexit, but at the same time, it looks as though there's good value in that. And again, just comparing that to other GBP pairs. So here's GBP CAD. looking the same. Level of support looking really nice and bullish, throwing that down onto the weekly. That's also now in an uptrend. Comparing it to pound Swissy, also for level of support, pushing high. Once we break these previous highs, we'll now officially not be in a downtrend on that monthly time frame. It's also in a very nice uptrend on the weekly. Pound yen, again on this one, coming off a level of support, also in an uptrend. So every single GBP pair across the board is looking really nice and bullish. They've got monthly support levels. They are at least attempting to bounce away from and find that as their bottom. The confirmation will be when we start to break the previous highs on the monthly and weekly timeframes, at least on the monthly. Once we break up through the next key levels, then we'll be sitting and going, okay, it looks like GBP is actually now going to strengthen. At the same time, ladies and gentlemen, we also have a bit of a weaker US dollar at the moment, and that will certainly help. We can see Euro charts are climbing in their own way because they're getting a little bit of help from, certainly if I go across to the euro itself, euro dollar, we're getting a little bit of a boost from a stronger, from a weaker dollar, which we haven't had in a while. So that's it. So for me, I will be cautious around any key events related to that could impact the euro or GBP, but they are trending. There are some, I'm amazed, as in I'm continuing every week to see 5 or 6 of these types of setups occurring across the board. Not every single one of those is a winner. Some of them make some money, some hit my targets. You know, some of them make a good return. But it's relatively easy for me. Every time at night, all I have to do is look at about 20 odd charts, and then there's either a setup or there isn't. Price is trending well, pulling back into the moving averages, and I can take advantage of that retracement by placing an entry that triggers me in. So and that's effectively it. I mean, just in terms of the time we're limited on, I can't really go into it in more detail. It's not on purpose, it's just time limitations. But I want to say thank you for the time. So I think obviously we've come to the end of our time. You can find me if you want to follow, just learn a little bit more about this. And obviously what I do is obviously I trade my own accounts and I do offer mentoring services, but I'm looking forward to coming back and talking more about this for ActivTrades. So I do look forward to hopefully seeing many of you in future webinars and then you're free to ask any questions you want where I can assist. So I think what I need to do is, Simon, I'm going to head off. If I exit the webinar, somebody else may have to end it, but that will be it from me.
Thank you very much, Adam Harris. Thank you very much indeed for that. Yes, I will close out the webinar, and thank you very much for your time and answering all the questions. And yeah, look forward to seeing you again.
Great. All right. Thank you very much. You're welcome.